Why the Fed's $95 billion a month quantitative tightening can't even trigger market volatility index VIX above 25 in this sick bear market. Fears of another liquidity crisis have entered the mainstream, with many people guessing what will cause the next financial upheaval. Right now, all triggers have been suppressed, but not for long. The great liquidity drain is here. The peak in global growth, paired with the long-awaited Fed tightening cycle, ended the mania in the final days of 2021. After an epic financial bonanza, we witnessed the rise of a risk-off environment, a slow grind lower in the Nasdaq. 2022 was believed to be the year for another financial Armageddon, but it never came. Why the Fed's $95 billion a month quantitative tightening can't even trigger market volatility index VIX above 25? How the volatility is being manipulated today. I will explain it all right after this. And of course, smash the like button. If you want to be my good boy, apply to write your first book with me. Welcome back to the Audacious Money Witch channel, where we talk about macroeconomy, stocks, bonds, and commodity markets. If you like any of these topics, you are intelligent. That's why you're here. And you know what to do. And push my button if you like what you see in today's video, because I can't push it from this side. This video is brought to you by my Patreon. If you're a good boy, go to patreon.com/magicalgoddesscheryl to add more meaning into your life. If you play your cards right and completely submit like my good boys do, then I will take you under my wing. Author of best-selling books, Goddess Cheryl. My good boys always get rewarded handsomely. You are such a good boy. You like hearing that, don't you? You want to get into the bookstore. You want it to be real. You want it to be true. You need to be my client, don't you? The usual meltdown we've seen before in previous cycles was met by trillions of excess liquidity desperate to find a home. Unlike the 2020 crash, the monetary excess era was able to neutralize levels of volatility that could cause a crisis. It took a while, but over time, market participants not only adapted to this new slow grind regime, but reinforced it. So much that the market structure has been shifted to enable the unhealthy suppression of volatility. Today, few are worried about protecting against losses. A major flaw of finance is that it nearly always mutates the very instruments meant to protect investors into crisis-inducing time bombs. Coincidentally, over the past few quarters, we've seen the early innings of the latest instant play out, this time in derivatives markets. As market participants have adapted to the slow drip down regime, they have come to think of buying protection using options as futile. Hedging with options only makes sense if you are expect to implied vol to a soar. But today's market has been defined by volatility suppression. One of the biggest losing trades of last year was buying VIX products or other long volatility proxies to hedge against falling stock prices. This, as usual, produced theories about the VIX being manipulated by the shadowy outlets. In reality, the lack of volatility, which usually spikes in bear markets, can be explained by today's status quo. Without a catalyst like a virus or banking panic sparking fear, the latest market downturn has been a snooze button. Volatility is elevated, but also contained by cash-rich parties, awash with capital and tired of losing money elsewhere. Speculators have started piling into options that expire on the same day, known informally as ODTE. These same-day expiries now make up a whopping 40 to 60% of daily options volumes. What could go wrong? A lot, it seems. A major misconception is that retail investors, like in the 2020 market mania, are now driving another speculative frenzy in the short-term options market. In reality, the dumb money is a mere 6 to 12% of ODTE volume. Institutional traders are the major driving force. The smart money is now exploiting a new regulatory loophole in the options market to make a quick, lucrative buck. They are selling large amounts of deep out-of-the-money ODTE options without having to post margin to clearing houses who don't count intraday expiries. It's easy money but fraught with risks. The reason these entities have blown up yet is that their actions have fueled and reinforced the volatility suppression dynamic. When not if they vanish from ODTE options, those needing to cover will have few parties to sell to. The market is heavily concentrated, with a few types of players providing most of the liquidity. Banks don't want to bear the risks while hedge funds want to avoid the wrath of angry clients. That leaves market makers, algo traders, and dynamic hedgers. Therein lies the hazard. When you pair the sudden exit of a large market player with how liquidity in the stock market has sunk during the Fed's tightening cycle, we could see high levels of volatility, which you'd usually expect in a bear market, make an unwelcome return. If the rules of the game change, volatility could return to its former spiky glory, turning this bear market into a normal volatile storm. All it takes is an unexpected departure from a large market participant or a sudden move from a regulator who started to take notice. Today, similar threats linger. Low volatility trends to manifest lower volatility, creating the ideal incentive structure for blow-ups. We're witnessing the largest compression in an already illiquid market. Whether it's the private sector, regulators, or a combination of the two that causes the next volatility cascade. This is a match that has yet to be lit. A similar scenario exists in many areas of financial markets. It's the spark before the explosion. Meanwhile, many people have started to point to the gradual rise in emergency loans that the Federal Reserve has extended through its discount window, where it acts as a lender of last resort to banks in need of funding. This, however, is only an early sign of stress. The rise in loans does not imply a banking panic, but more a shortage of liquidity gaining momentum. A more badass explanation also exists. Consumers are becoming wise to the game, being played by the banks, as the big banks pay barely any interest. Consumers have likely decided to transfer their deposits into money market funds, around 4.25% yield, 3 months treasuries, 4.5% yield, and even the stock market. Consequently, as depositors withdraw en masse, banks have had to replace these deposits. Again, poor liquidity is just a match without a flame. With bad incentive structures only starting to turn sour and liquidity in the system far from constrained, we turn to the most imminent hazard. As of September last year, the Fed's QT quantitative tightening program has entered full swing. Yet its effects have been minimal. QT has had much less of an impact on deterring inflation and risk sentiment than policymakers, commentators, and the financial media expected. Still, the QT process will drain enough reserves from the system to prompt monetary leaders to increase liquidity before a squeeze, or the most probable scenario, react to another money market tantrum when hysteria emerges. Liquidity is about to decline rapidly in the largest, most aggressive Fed rug pull since, well, the Fed's last attempt to reduce its balance sheet. The Fed will now try to roll off a maximum of $95 billion a month from its $8.5 trillion asset portfolio. The size of the balance sheet, although enormous, is not an imminent concern of the Fed or the banks. Instead, it's the number of reserves that QT also sometimes removes when bonds are rolled off. To the Fed, if reserves fall to $2 trillion, the potential for chaos emerges. While we predict it will take around 9 months to run into issues, some Fed experts we spoke to indicated that liquidity problems could emerge within 6 months. This again ties in with the common theme of adequate liquidity that's withering slowly. We're in the transitory Goldilocks period, where slowing growth meets disinflationary forces. Unsustainable levels of volatility and illiquidity will return to markets once again, prompting a long-awaited Fed pivot. But the real dilemma is knowing when this will occur and what will be the trigger. When volatility suppression turns into a volatile blow-up, the response from monetary leaders will look all too familiar, but in much greater magnitude. The Fed's volatility suppressor, QE, the only true entity capable of stifling market turmoil, is about to face its latest challenge. And this is my collaboration book with all my incredible clients. It's called It's Already Yours, Adversity Equals Success. Such an amazing book with such incredible authors. And my book, Rainbow Focus. You are such a good boy for watching my video right till the end. Bye.